Hello, ladies and gentlemen, and welcome to this webinar brought to you by fxstreet.com. This is High Probability Trading Strategies, Entries, and Exits. My name is James Chen. I'm the Chief Technical Strategist at City Index Group. We are a global brokerage in the foreign exchange and CFD markets located throughout the world. I'm coming to you right now from the U.S., around the New York area. And this is my monthly webinar on FX Street. Let's get started real quick. If you have any questions throughout the course of this webinar, please feel free to type them into the chat window, and I'd be more than happy to answer any questions that you may have. Okay, so let's get started. Today is July 1st, 2014, and let's get started. What I'm going to be doing today is I'm going to be providing you with my approach to trading in both the forex market as well as the indices and pretty much every market that I trade. I'm going to be providing you my technical approach as well as showing you the charts and the real-time charts and showing you exactly what I'm looking at from this perspective. So let's get started real quick. First, a quick disclaimer: financial trading carries a high level of risk to your capital with the possibility of losing more than your initial investment and may not be suitable for all investors. Ensure that you fully understand the risks involved and seek investment advice if necessary. Okay, so let's move forward real quick. Now, very quickly about myself, for those of you who are not familiar with who I am or what I do. My name again is James Chen. I'm the Chief Technical Strategist at City Index Group, where I trade, I analyze, and I educate in the various financial markets, primarily in the forex markets, as well as in various CFD markets, including individual equities, indices, futures, commodities, etc. I've been trading as an active trader and analyst in these markets for over 15 years, using primarily technical analysis. I'm a chartered market technician, which is a designation for technical analysts. I also publish daily market analysis for major financial media. I've appeared regularly in the media for providing my analysis as well as trading strategies. I've authored many articles. I'm the author of 2 books, Essentials of Foreign Exchange Trading and Essentials of Technical Analysis for Financial Markets, both written several years ago. And I'm also the author and speaker for High Probability Trend Following the Forex Market, brought to you by fxstreet.com. Okay, so let's get started real quick. This is just a quick view of our mobile platform from City Index. So you could take a look at that. Check us out at cityindex.co.uk. Okay, so as I mentioned, today's topic is high probability trading strategies, entries, and exits. I'm going to be talking about my exact approach to the markets, how I trade on a daily basis, how I provide my analysis on a daily basis, and my trading and my analysis has essentially not changed. So for those of you who have heard me in the past, you're going to hear some of the same things, but the markets have changed. So I'm going to be showing you, exactly what I'm looking at from this perspective at the current markets, especially on the euro dollar, and how about that pound dollar? You see that huge move to the upside that has continued the very steep uptrend that we've been seeing for almost a year now. So we're going to take a look at that. Yeah, the market, forex scaled market is very sideways and choppy at times, absolutely. So I'm going to be showing you exactly what I'm looking at from that perspective as well. Okay, so high probability trading strategies, entries, and exits. I'm going to be showing you this only because these are my primary principles for entering and exiting any trade in any market. Some of you may have seen this before. Essentially it's very simple, but there's a lot behind it, and trading can be simple, and it's perhaps most effective when it is. Okay, so trade entry and exit principles. One way to enter a trade, as far as I'm concerned, is the right direction at the best possible price. So yes, although the markets are very often sideways and choppy, and we can see that on many different currency pairs and many different markets, including, right now we see Aussie dollar. Well, Aussie dollar just made a new 2014 high, but at the same time, for the past couple months, it's been entrenched in a sideways trading range. I'm going to talk about that in a second, but with very defined support and resistance levels. So we'll talk about that in a minute. But you know, and essentially, when I'm looking to enter in any trade, I'm looking to go into place my trades in the right direction, which is simply within the direction of the trend, and whether this be a longer-term trend or a shorter-term trend, and at the best possible price. So what I don't like to do is to get into trades that are, for example, at the very highs of a market, get in long at the very highs of the market, or get in short at the very lows of the market. So I like to get in at better prices. So what does that mean? So when you get into any trade in the right direction, which is with the trend, the best possible price is usually after a dip or a pullback or a correction or whatever you want to call it, or a retracement. So I'm looking to get in at a good price in the direction of the prevailing trend, in the direction of the momentum of the market. Now, just as important, and some may say even slightly more important, is how to exit a trade. So in order to exit a trade, there are two possible ways to exit a trade. One is at a loss, the other is at a profit. Generally speaking, and you know, from a very simplistic point of view, at a loss or at a profit. Now, in order to exit a trade at a loss, and of course we all don't want losses, but they are part of your of any type of trading. You get out of a loss where the market's telling you you're wrong. And basically, I use technicals, I use price action, I use support and resistance to tell me where the market is telling me that I'm wrong about my direction. Now, in terms of profit, which is, of course, where we all want to go, profit, I like to get out preferably at a multiple of my defined risk. So if I have a certain risk level, i.e. where my loss is, where my potential loss is, I want to be able to get out of profits consistently at a multiple of that defined risk, so that I don't have to have you know, a very high win ratio in order to become net profitable. So again, one way to enter a trade in the right direction at the best possible price, two ways to exit a trade. If at a loss, it's exactly where the market's telling you you're wrong. And if at a profit, you want it preferably, generally speaking, and over the long run, at multiples of your defined risk. Okay, and when I say multiple, a multiple could be at least 1-to-1, but preferably in many cases, especially if you're trading from a trend following perspective, you want to have at least 1-to-1, but more than 1-to-1 is preferable. Okay, so those are my trade entry and exit principles. I'm going to go through my you know, technical strategy from a discretionary point of view, and this is trading with Confluence. And you'll hear me talk about Confluence a lot, only because it is perhaps the most important aspect of my trading. When the stars line up in your favor, in favor of your trade, that's when I would deem it a higher probability trade. And that's what I'm looking for. I'm looking for high probability trades only. I'm not looking for you know, mediocre trades. I'm not looking for, obviously I'm not looking for bad trades. I'm looking for the highest probability trades I could find, and that will raise you know, that will raise my my probability ratio, or my win-loss ratio, and couple that with you know, having your profits be multiples of your defined risk. Then you know, you can shoot for, you could target high probability trading and net profitability in your trading. Okay, so trading with Confluence. I'm going to go through the tools, and then I'm going to go straight to my charts and show you exactly what I mean. Okay, so what is the Confluence principle? The Confluence principle is simply agreement. So what do I mean by agreement? Well, agreement could be agreement amongst timeframes. A couple months ago on FX Street, I did a webinar all about multiple timeframes. That is one type of Confluence. Today, I'm not going to be talking about multiple timeframes. Today, I'm going to be talking about Confluence, or an agreement of different technical tools, which includes support and resistance, chart patterns, etc. So basically, the principle behind this is that you know, we want to look for areas where more than one factor provide rationale for a trade entry. So, for example, if you see a pullback that pulls back to the 38.2% Fibonacci level, let's say, okay, I'm not just a Fibonacci trader. It's part of my arsenal. Actually, it's a pretty small part of my arsenal. But let's say that there's a pullback to the 38.2% Fibonacci ratio, and this happened on the euro dollar, which we'll look at in a second. Okay, and let's say that also occurs right at an established support level. This also happened on the euro dollar at the 135 level. Okay, so you have a confluence there of not only one technical tool, which is the Fibonacci level, but also you have an established support resistance level, which is the 135 level on euro dollar. So you put that together, and preferably if you have more, if you have further indications that this currency pair may turn at that level or break out at that level, then you have a stronger rationale for getting into a trade, and therefore you have a higher probability type of trade. Okay, so we're looking for areas where more than one factor provide rationale for a trade. The more rationale there is for a trade, the higher probability that trade will tend to be. Okay, so that's the principle. Now, I'm going to show you my tools really quickly, and then I'm going to go through the charts, and then if you have any questions, please feel free to ask. Okay, so trends. Trends are very simple, and yet they can be very complicated because, as Forrest Gall very correctly noted, markets are often very sideways and choppy at times. Absolutely, but generally speaking, we're looking for overall trends to dictate the possible momentum of the market. So although, for example, we may have a very sideways market on Aussie dollar for a prolonged period of time, we're looking for perhaps continuations of the prior trend. Now, an exception to that may be the dollar yen. If you look at the US dollar against the Japanese yen, you'll see that we've been in an incredibly prolonged trading range, and not a lot has happened. That's why I've sort of stopped talking about it, stopped looking at it for the time being, because really there's nothing much happening in the dollar yen. But that can't be said for many of the other currency pairs, as well as the indices, individual stocks, etc. So if we look at, for example, the pound dollar is the best example of this. The trend has been remarkable, and it's been prolonged, and it's been very sustained. And we see many areas where we could, get into potential trades on the pound dollar. Probably not now, because it's at its, very long-term highs. But there are many areas of getting into trades such as that. For example, also, we look at the indices. We look at the FTSE 100 if you're in the UK, or we look at the S&P 500, or we look at the NASDAQ, and we see that the trends also have been remarkable, and people have been calling for the ends of these trends for a long time, and it hasn't really happened. We are looking for corrections and retracements within that trend, but for now, these trends are very strongly to the upside, and there are many opportunities to play these trends. Okay, so trends, the best trends are usually prolonged, and we're looking for good entries into those trends. So what is trend trading? It's basically taking the path of least resistance, riding the market's momentum. We could draw trend lines, as I've done here. So an uptrend support line is simply connecting the lows, and we could see that on many charts. The downtrend resistance line is simply connecting the highs, and we're looking for opportunities within those trends, within those trend lines, to get into potential positions. Okay, now, as you may have noticed, if you've been trading for any length of time, that trend lines are not exact sciences. They're simply guidelines. Okay, they help you decide where the market momentum may be going. In terms of actually trading off of trend lines, I don't often trade based on trend lines alone. I'm looking at trend lines and trends as simply a part of the confluence, a part of the whole, a part of the agreement that I'm looking for in order to get into or get out of any trade. Okay, so these are trends. Besides trend lines, moving averages can also be used to identify trends. Okay, if I'm talking a bit on the simple side, it's because we want to start with the basics, and then we want to branch out and go into deeper and more involved technical. So that's exactly what I'm doing, and then I'm going to show you the charts in a minute. Okay, support and resistance. This is probably the most important aspect of my trading besides trends. Okay, support and resistance. Look at any chart. Look at the Aussie dollar. Look at the support on that, what is it, the 92 level. In the absence of having a chart in front of me, the 92 level or so. Remarkable support there in the trading range that's been occurring for quite some time. So support is simply a floor. It is where we expect price action. We expect demand to occur at a support level. Resistance is simply the opposite. Resistance is a ceiling. It's where we expect to see supply, where we expect to see selling going on. So support is where we expect to see buying, and resistance is where we expect to see selling. And why do we expect to see buying at support? Well, essentially, this is all about market psychology, mass market psychology. So at a certain support level, let's say 135 on euro dollar, why do we see support there? Because essentially there is market memory. So traders and market participants as a whole are looking at these levels and remembering these levels and remembering that they seem relatively low. And therefore, when price action goes to those lows, we see some buying activity. Okay, and therefore we see some turns to the upside. And also on Aussie dollar, we could see that at the 92 level. Now, in terms of resistance, why do we see selling, or why do we see supply around highs around certain levels? Because those are the market memory of the mass market is saying that there's that particular level seems to be relatively high, and therefore people are looking to go short or to sell at those levels, and that's why we're seeing resistance. So it basically all goes back to market psychology, but that doesn't really matter. What really matters is that oftentimes, or much of the time, you're going to see specific activity or events occur around, price events occur around those levels. So that's why I'm looking at support and resistance. Now, everything else I'm going to be talking about from after support and resistance all pretty much goes back to support and resistance. Okay, so everything I'm going to be talking about, whether it's chart patterns, whether it's candlestick patterns, whether it's Fibonacci levels or pivot points or what have you, they all have to do with support and resistance. So support and resistance are extremely, extremely important in any type of trading. Even if you're a fundamental trader, even if you just, for example, look at the fundamentals of the market and then decide upon direction from there, still support and resistance are extremely important, or can be in your trading. Okay, pullbacks and retracements. Now, when you have a trend, you obviously have pullbacks. And in those pullbacks, those are where I'm looking, once again, for the best possible entries into any type of trade. So if I see a strong trend, like we've been seeing for the past year on pound dollar, then I'm looking for simply pullbacks within that trend to look for potential long positions. Okay, same thing to the downside. For those instruments, those financial instruments that happen to be, trading to the downside, trending to the downside. So I'm looking for pullbacks and retracements, and these are part of my Confluence. Ranges, again, as we see on the Aussie dollar, as we also see on the dollar yen, as I've mentioned, but dollar yen the volatility has been extremely low, and there hasn't been much price action. So it's in a very, very tight range, sort of going to the downside on dollar yen, but still very tight range, not a lot to do there. Looking for a breakout, but it seems that whenever there is a breakout, there's very little to no follow through. So not a good instrument, at least from my perspective, to trade the way I trade. So we have ranges here. Ranges can often be traded looking for breakouts of those ranges, or if it's a wide enough range or a tall enough range, looking for trades within those ranges, like, for example, on the Aussie dollar. Bounces and breakouts. This also has to do with support and resistance. Whenever we have a support resistance level, we're either looking for a bounce or a breakout. Again, some event often or much of the time occurs around these support and resistance levels, and those two events would happen to be either a bounce or a breakout. That's pretty much it. So in terms of support and resistance, it's very simple. Look for a bounce or a breakout. Now, Fibonacci ratios, as I mentioned before, they can be very helpful. They've been remarkably helpful on the euro dollar. and we'll see that in a minute. So, but again, I'm not a Fibonacci trader, so I'm not going to be looking at Fibonacci's and waiting and hoping around the 38.2 and the 61.8% levels, because that's not what I do. So basically, what I do is that I'm looking for these to confirm or to provide an agreement with some other tool that I have, whether it be a support and resistance level, or a pivot point, or a moving average, or a trend line, or what have you. So again, I'm looking for this just as a way to confirm a potential turn in the market. So these are Fibonacci ratios. The most important that I use are the 38.2%, the 50%, and 61.8%. This is not rocket science. This is this is very simple stuff. The only reason I'm looking at stuff like Fibonacci's is that a lot of traders, a lot of the mass market, are keeping in mind these very important levels, and oftentimes things will occur around these levels, especially if it's coupled with some other factor like a support or resistance level, or or a moving average, or what have you. Okay, moving averages. Now, moving averages can often be used in the form of support and resistance. So, oftentimes, for example, I use the 50-day moving average on my daily chart. I use the 100-day and the 200-day moving averages, and these are moving averages that a lot of people look at. And I like to look at things that a lot of people look at because price events tend to occur around these areas. So again, if a Fibonacci level lines up with moving average and it lines up with support and resistance level, and there's also, let's say, a candlestick pattern. Let's say there's some kind of a doji, or there's a hammer, or a shooting star, or what have you, around those levels, then that for me is a higher probability type of trade. And Forex Gal, is this being recorded? Yes, it is. I believe so, and this will be posted probably by tomorrow. Okay, so let's move on here. Oscillators. Oscillators, what I usually use for our turns in the market, but more importantly, I use them for divergences. And like Fibonacci's, I'm not a divergence trader. I use divergence in conjunction with the other tools that I have. So you'll see a bunch of divergence lines when I show you my charts in a minute. But those are basically to confirm moves in the market. And usually the divergences I look for, and if you don't know what a divergence is, please bear with me. I'm going to show you in a minute. But what I use divergences for is to provide some type of a signal or an indication of a potential turn in the market, where momentum has waned or momentum has lessened. Okay, so oscillators are essentially momentum indicators. Where they show divergences is where we see a waning of momentum. And when we see a waning of momentum where price keeps going one direction, but momentum is waning, then we could look for possible turns in the market, possible exhaustion of momentum, and a potential turn in the market. So I'll show you that in a minute. Okay, so we're going to quickly go through candlestick patterns. I'm not going to spend a lot of time on this. This is a bar, this is a candlestick. Same exact thing, open, high, low, close. What's the advantage of using a candlestick? Simply is that it provides a visual depiction, a better visual depiction of what's going on in the markets. Okay, they provide the same exact price information. It's just the candlesticks provide a bit better visual depiction. That's why I use them. Now, what are the candlestick patterns that I use? These are basically it. One of the most important are these two right here. And you've probably heard me say this before if you've heard me speak ever before. But here we have a hammer, here we have a shooting star. What does this mean? Simply it means a hammer is price actions moving down. And then on this last candle here, which is called the hammer candle, we have an open near the highs, and then we see price action going lower and then coming back up to close near the highs. And what does that mean? That depicts potential exhaustion in that downtrend. Okay, so that depicts potential exhaustion in the downtrend. Price action tried to go to the downside, but came back up to the upside. It got rejected near the lows. Now, again, we're talking about Confluence here. So if this occurred near a support level, or let's say a Fibonacci level, 61.8% Fibonacci level, okay, or any of that, then we see a support level there, and it moves back up. That's talking about potential rejection near the lows and price action coming back up, a failure to continue this downtrend, and that's called a hammer. It's a very powerful signal. Again, I would not use this hammer in isolation. I would use it only in conjunction with other tools that I have. Okay, Richard, we are open to personalized coaching. That would be great. I will provide. I don't actually provide personalized coaching at this time, but I will provide you with my contact information for any questions that you may have. Okay, so shooting star, simply the opposite. Okay, we have a move to the upside. We got an uptrend. Price action goes to its high, comes back down, closes near its lows. Rejection. This talks about rejection near resistance. Okay, if there's a resistance level there, we see rejection near resistance, failure to continue this uptrend, and therefore we're looking at a potential turn to the downside. This is a shooting star. The hammer talks about a potential turn to the upside. If this occurs around other signals within your confluence, within your agreement, then they can be very powerful, very high probability trades. Okay, I'm not going to talk about these because I don't think we have a lot of time, but engulfing patterns can also be part of your trading, especially at a support level. Bullish engulfing pattern can show, a potential turn to the upside. A bearish engulfing pattern can show a potential turn to the downside, especially if it's around a resistance level. Okay, chart pattern breakouts. Okay, I'm going to go quickly through this because we don't have that much time. Okay, what are chart patterns? They're simply support and resistance, same thing. Everything I'm talking about here goes back to support and resistance. So what are flags and pennants? They're simply, chart patterns or price patterns where someone put a name to them according to what they look like. But what do you really want to know from these patterns is what the story that they're trying to tell you. So if you take a look at this flag here, what story is this trying to tell you? So we have this flag here. We have this uptrend here, and then we have a pullback, a consolidation, if you will, and then a breakout to the upside. That's a flag. So this is an uptrend. Okay, so flags, pennants, any type of chart patterns, there's basically breakouts of support and resistance. So we have a trend here. We got a pullback and a consolidation, a break to the upside. Same thing to the downside. A move to the downside, a consolidation, a break to the downside below support. Okay, if this occurs around an established support resistance level, if it occurs with a engulfing pattern, let's say, if it occurs with around a key Fibonacci level or a pivot point or a moving average, then they can be very, very powerful. And you'll see these flags and pennants all over your charts. Now, if we look at triangles, same exact thing, different name, same exact thing. Okay, we see a trend, we see a consolidation, we see a breakout. That's all it is. These different names, I really don't care what you call them. You could say the ascending triangle, the ascending triangle is biased to the upside. Okay, we could see a biased breakout to the upside, but that's not necessarily the case. It could be or could not be. What I'm looking for is the story it's telling you. We have a trend, we have a consolidation within that trend, and trends always consolidate. Whether it's a pullback or a consolidation, they're always consolidations, and then we're looking for a breakout to resume the trend. Same thing with symmetrical triangles. Descending triangle can be deemed a more bearish chart pattern, but not necessarily so. All we're looking for is a trend, a consolidation, and a breakdown of that, a breakout or a breakdown of that consolidation. Rectangles, same thing as trading ranges. Okay, wedges, we see a wedge that occurred on the euro dollar. I'm doing this from memory because I don't have my chart in front of me. But we saw a big wedge on the euro dollar, and that's exactly where the price fell. Okay, it fell down below this wedge. I'll show you that in a minute. Now, it fell down below this wedge, but before that wedge occurred, before that breakdown of that wedge, okay, before that breakdown of the wedge, we saw many other confluence factors. Okay. Harsimran, will you explain your method, or is this webinar just a basic covering one? Well, I'm going through the basics now, but this is my method. This is actually my method. I have many different ways to trade the markets, and in the past I've shown different strategies, including my multiple time frame strategies my more automated strategies. But for now, this is my approach. This is how I trade the markets. In terms of looking at the markets every day, looking for potential opportunities, I'm looking for Confluence. Okay, it's covering the basics, yes, but I'm using the basics within the strategy, and I'll show you exactly what I mean when I show you my charts. So again, on the euro dollar, we had a Confluence with a wedge, with a rising wedge, and that was a bearish signal. Okay, and this occurred right around a resistance level. It also occurred around a divergence, price oscillator divergence. You put that together, and that was a strong Confluence to the downside, and then we saw that big move to the downside. Okay, so reversal chart patterns. Here we have, okay, so we look at the Aussie dollar, okay? We saw those 3 head and shoulders in a row. One was, again, I'm doing this from memory. One is from to the downside. I'm sorry, one was a reversal to the upside, then a reversal to the downside, and then, most recently a reversal to the upside. Those were major head and shoulders reversal patterns, okay? So we saw those on the Aussie dollar in a very strong way, and these can also be used very well in your Confluence trading. Okay, quickly over divergence, and then go to my charts. Divergence, what is divergence? Okay, let's go over all this real quick. I'm not going to go through this whole slide, but what is divergence? It's simply an imbalance or disagreement where extremes in price and an oscillator diverge in relative direction. Now, what does that mean? Again, as I mentioned in the beginning of this webinar, an oscillator is a momentum indicator. Okay, an oscillator could be RSI, Relative Strength Index, or stochastics, or MACD, or CCI, or whatever you want. Okay, so those are all oscillators, and basically what they do is they move within bounds, between bounds, whether between 0 and 100, or a negative number and a positive number, or what have you. But they move between bounds. Now, these are essentially momentum indicators. They give a potential measure of momentum. Now, when there's a divergence between price and the oscillator, we're looking for price to correct that imbalance. So let's say, as we see right now on the pound dollar, we see price going up and up and up, okay? If I see a divergence, which means that the oscillator is showing a loss of upside momentum, what I'm going to do is I'm going to be looking for other signs that perhaps price will move to the downside, will correct to the downside, or retrace or pull back to the downside, okay? We haven't seen a reversal in the pound dollar, obviously, but we could be looking for corrections. We could be looking for retracements. So that's where oscillators show up very well. Also, divergences can be used when you have a pullback. So let's say, let's say on the pound dollar, we have a move to the upside, okay, and then price pulls back, and then it makes lower lows, okay, and then on the oscillator, we see higher lows. So that is a loss of downside momentum and a potential for a turn back up after the pullback and a potential resumption of the uptrend. So we can use divergences in that manner as well. I'm going to show you in a minute. Okay, so how do we measure divergences? Obviously, we have price. Number 2, we have an oscillator. I tend to use stochastics a lot for my oscillator. Now we're using a trend line drawing tool to compare heights of swing high to swing low, okay? And this is exactly what it is, okay? So a bearish regular divergence is simply this: a higher high in price, a lower high in the oscillator, okay? And this happens to be an RSI, okay? So higher high in price. Again, price is moving up, okay? You would think that momentum is moving up, but then you look at the momentum indicator and it's moving lower. It's got a lower high. This is called bearish divergence, okay? So you got a higher high in price and you got a lower high in the oscillator, in the momentum indicator. So perhaps there may be a turn to the downside, whether it's a pullback or a correction or a full-blown reversal, okay? So you could see any of those, or you could see price moving back to the upside. So this is just one of the tools that I use in conjunction with the others in my Confluence, okay? So higher highs, and here we happen to see, what do you call this? Anyone know? Okay, this is a shooting star, okay? So we see this move to the upside, This candlestick is a shooting star. Okay, so move to the upside, shooting star. Now, we saw a shooting star back here too. Okay, and there wasn't much follow through to the downside. That's why I'm looking for a confluence. Okay, I'm not just relying on shooting stars and hammers. I'm not just relying on divergence. I'm not just relying on Fibonacci's or support and resistance. I'm relying on all of them. I'm trying to get as many signals as possible to put together and make for a higher probability trade. Okay, so we see here a higher high in price, a lower high in the oscillator, and we see a hammer candle. A shooting star candle there. A potential, if this occurred right at resistance, and I don't know if it did or not. This is just a screenshot, but if it occurred right at a resistance area, this is about as strong a signal as you could possibly get for a potential short position. Okay. Now, where would you take that short position? Would you take it right at that shooting star candle right there? Not really, because you don't really know yet if this is going to turn into the pullback or the reversal that you're looking for. So perhaps you could look for a breakout. So, for example, you could draw, and I don't have a drawing tool right now, but you could draw a line right there and look for the breakdown below that line, and that's showing you that this reversal is indeed perhaps happening, and momentum is going to the downside, and it's agreeing with all these reversal signals. So that breakdown would be, or could be, a trigger for getting into that trade. What is bullish regular divergence? It's simply this: a lower low in price. So you're looking at price action move to the downside, and then suddenly here we see a higher low in the oscillator, and this happens to be stochastics. A higher low in the oscillator. This is showing a waning of downside momentum, a lessening of downside momentum, and perhaps a turn to the upside, maybe a turn to the upside. Okay, but we also have a very nice spinning top pattern right here on this low. And also, if this occurs right around a support area, which I think it does, if it does, then we could be looking for a turn to the upside. Okay, and then we could be looking for triggers to get into that trade. Okay, I'm not going to talk about hidden divergence. That's enough about regular divergence. So again, higher high in price, lower high in the oscillator is a disagreement in momentum and price, and a possible turn to the downside if coupled with other tools. Okay, I'm sorry, bullish regular divergence, simply the opposite: lower low in price, higher low in the oscillator, and we are looking at potential move to the upside because we're seeing a potential loss of downside momentum. Okay, let's turn to the charts real quick. Bear with me for 1 second, if you will. Okay, let's take a look at this simple chart. This is a live chart of the euro dollar. Now, as we can see here, a lot is going on here. If we take a look here, let's just go back a little bit in time. Well, right now, as we can see, we just hit the around the 37 resistance level here, and this is on a rebound to the upside, so around the 37 resistance level. Now, if we take this here, we see this from this drop up here near the 140 level down to this lower around the 135 level. Okay, we see that big drop to the downside, and then we see a turn back to the upside. Okay, well, we had a sort of a hammer candle here, but then it continued to go down, but it did not go down below the 135 level. Okay, now this 135 level also happens to be 38.2% Fibonacci retracement of this move from down here, and this was where the major move occurred down here in. Let me move this chat window real quick. Okay, this major up move occurred. It started almost exactly a year ago in July of 2013. Okay, so we saw this major up move to the upside. Okay, my target for quite some time had been the 140 level to the upside. Came close. You know, it hit a high of 139.93 or so. Did not hit my target at 140. My analytical target at 140. But it came close. And then what happened was it formed this longer wick to the upside. I don't know if you really want to call this a shooting star candle, but it hit this long wick to the upside. It was right at resistance. Okay, right at resistance. This last high, which was back in March of 2013, I'm sorry, March 13th of 2014, just this past March, we saw a high right around the 139.65 level. So this is right around the resistance level here. We saw price action hit that multi-year high, pull back to the downside down to the 137 level, and then go back to the upside. It hits resistance, and it has this long wick. So again, rejection near the highs, okay? And then simultaneously what happens, but we see a, what do you call this? This is a bearish regular divergence. Higher high in price, lower high in the oscillator. This happens to be stochastics, 1433. This is a lower high in the oscillator. Okay. Then we have this longer wick. I wouldn't call it a shooting star, but I don't care what you call it. It's got a long wick. Potential rejection near the highs. Potential rejection near the what do you call this here? Near the last high, the multi-year high. So very strong resistance. We see a long upper wick. We see bearish divergence on the oscillator, and then we see a break to the downside. Now, if you wanted to look for a potential entry, this could be it. You know, some may say this is a later entry. This is a daily chart, by the way. But this is, some may call this a later entry if there's a breakdown below here, okay? A later entry, but for me, it's a potentially safer entry, okay? So I have this uptrend support line. Again, this is a wedge, okay? This is the wedge I was talking about, okay? So here's a wedge here, and then a breakdown of that wedge. A rising wedge is usually, in a rising market, a rising wedge is usually a bearish signal. So we've got another confluence factor there, a breakdown of that of this wedge. We also have, what is this right here? This is a 50-day moving average. Okay, so that was a confluence right there of that 50-day moving average. It also, oh, that's basically it. Okay, so we got all these confluence factors here of this breakdown, and this breakdown goes on and it breaks down below the 137 level. So you had a potential trigger there. Some of you may have looked for an earlier trigger on a shorter time frame. Fine, you know, that's fine. But we saw that breakdown there. It went down below, and then it hit the 137 level, which was strong support, as we can see here. Strong support right here. Okay, and then we saw a breakdown. So then we saw a breakdown here. And then, as I just mentioned, we saw a breakdown that went down to the 135 level, strong support, also psychological level, 135 level, and then it formed this this long wick. You know, I don't know if you want to call this a hammer candle, but you could if you wanted to. I wouldn't blame you if you did. But we've got a long wick down here. It hits the lows right around 135. This is extremely technical, by the way. So we see a low 135. It comes back up a little bit, but drops back down to 135. Okay, 135, very strong support, and then it pops back to the upside. Now we see a rebound to the upside, and then where do we find ourselves now? So we measure this move from this high up here, okay, down to this low down here. Oh, by the way, also we have this divergence right here. So we have a divergence right here. I mean, some of you may be thinking this is not really a divergence because we've got sort of an equal low here, okay? I consider this a divergence. So we got an equal low in price, okay? And then we got a higher low in the momentum indicator. Okay, usually you, for the best divergences, you want to look for lower lows in price. But here we have you know, for the purposes of Confluence, we've got a divergence here, okay? So we've got equal low in price. We've got a higher low in the momentum indicator in the stochastics. So that for me is a somewhat of a divergence. So we have a divergence there, but also coupled with this, you know, with a very strong support level around the 135 level. Okay, and then as I mentioned, we have a rebound to the upside, and a rebound right now we've hit, or we've come close to hitting the 137 resistance level that I've been talking about for the last several weeks. Okay, the 137 level. Okay, so it broke down below there. Now it's rebounding back up to the 137 level. We're at a critical juncture right now. What is this 137 level? It's yet another confluence factor. Why is it? Well, you take a look here. You measure from this high, right near the 140 level. You measure it down to this 135 level, and we've got the 38.2% Fibonacci level right around here, right around this, 137, the 137 resistance level. So we're at a critical juncture. Okay. Eventually, I'm looking for this to go lower. I mean, from a directional basis, I'm looking for it to go lower. For now, it's rebounded to the upside. Now, let's see what happens. As we're right near the 137 level, if there's a strong break to the upside, or if there's a turn back to the downside. In any case, we have our confluence factors all in place to help us dictate potential trades in the markets. Okay, and we could look for breakouts or what have you to dictate that. Now, let me show you Aussie dollar real quick. Okay, now we just hit a new 2014 high. Okay, 2014 high. As we speak, just today we hit a high of right now, as we speak, 94.92 is the high thus far today on Aussie dollar, and this surpasses the high back in April, and that high was at 94.60. Okay, so looking for potential upside. Now, what I was talking about before regarding support and resistance, you need look for, no further than right here. This low right here, around the 9200 level on Aussie dollar. We've got a low here, a low here, a low here. That is critical and key short-term support on this trading range that we had prior to the breakout today. So we had a trading range. We had very strong support right around there. This support level was also right around the 50% Fibonacci level of this run right here. So again, I'm always looking for confluence. Now, the 94.50 level is strong resistance to the upside. 94.50, 94.60 level, strong resistance to the upside. We've seen a tentative breakout to the upside. Okay, and then what am I looking for at the 96 level? What I mentioned before about head and shoulders, if you could take a look, oh, they're actually four in a row. If you take a look at this, I don't know if you really want to call this a head and shoulders, but it's just another chart pattern that contributed to the confluence factor of that potential reversal. So we see there, and then we see a very strong reversal pattern right here on this head and shoulders. Okay, left shoulder, head, right shoulder, and then we see this neckline here broke to the upside. It hit its head and shoulders target, and then formed another head and shoulders pattern, as we can see here. Neckline breakdown. Okay, if you wanted to use this as the right shoulder right over here, then we could have used this as the neckline. Breakdown there also would have hit. Okay, so breakdown there, and then it hit yet another head and shoulders pattern. Okay, now this head and shoulders pattern was marked also by this partial divergence. So we have a lower low in price. We got an equal low in the oscillator. Again, this is not a perfect divergence, but it's a partial one. We have a lower low in price, equal low in the oscillator, and a potential loss of downside momentum. And then we have price action finish this inverted head and shoulders pattern. Now, what is the target for that? 96 level to the upside. I've been talking that for about 96 for quite some time. How do we measure 96? We simply do this. We measure from the head up to the neckline. We measure from the point of breakout up to 96. And 96 is also a prior support resistance level, as we can see here. Okay, so again, I'm always using Confluence. I'm always using my technical tools, putting them together, looking for potentials, for potential trade entries and exits. So the 96 level, it's taken a while to get there, and it hasn't yet gotten there yet, but that is the target to the upside if we are to look at this head and shoulders, inverted head and shoulders pattern. We've seen it break out above the 94.50 resistance level. Now next level, 96 to the upside, and simply using a confluence of different factors. If we take a look here, right around this low at around the 92 level, again, very strong support. We see an equal low in price. We see a higher low in the oscillator, potential for a partial, I just made up that term, partial divergence, but some of you, again, may be saying this is not a real divergence, but for the purposes of using Confluence, it can be deemed somewhat of a divergence. Okay, so you got a higher low in the oscillator, we've got an equal low in price, and this occurs right around a support level. I haven't even looked at the candlestick patterns on this yet, but another confluence factor is that we've got a rectangle here. We've got very strong support here. And now, again, we're looking for further upside. Okay. Pound dollar, there's a lot to say about pound dollar. Let me, okay, but I think I've run out of time here. This is euro dollar. Okay, I showed you euro dollar before. This is pound dollar. Okay, I'm looking for 172.50 to the upside. That was a prior, long time ago, a support resistance level. But the thing is that in relatively uncharted territory, because we are major highs right now, we have a sort of an absence of potential targets unless you use things like Fibonacci extensions, which I tend not to use that much. Okay, so here, what do we see? We see a pullback on the pound dollar. Okay, we see a pullback. We could draw that trend line very well there. Okay, so that's a confluence factor there. We have this 50-day moving average. That breakout occurred right around it broke out above this pullback trend line. Okay, it also broke out above the 50-day moving average. Both confluence factors, and then it went up and hit its target at the 170 level. And if you've read any of my analysis for the past several months, 170 or weeks and months, the 170 level hasn't been the target to the upside. Finally, it's hit it. It went above 170. It pulled back. I'm looking for further upside. I wasn't necessarily expecting this move, but it's a pretty big move to the upside. Looking for 172.50 eventually, but looking for a pullback perhaps before then. Okay, so these are all opportunities to get into potential trades using Confluence of the different of your different tools. Okay. I'm sorry. I'm being told that we have to wrap up. So let me give you my email address real quick in case you have any questions whatsoever. Let me type that in, and then we will wrap up. Oops. Okay, james.chen@cityindex.com. Any questions that you have regarding anything I've brought up today or anything else regarding trading, please feel free to ask. And I'd like to thank all of you for your time today and see you next time on fxstreet.com. Thank you very much.